Tesla is one of the largest electric car companies in the world. It's been the market leader for electric vehicles in the USA for years now. Last year in 2021, Tesla's vehicles accounted for 69% of the EV market. All the other car companies are trying to play catch up with Tesla's electric vehicle dominance. A few weeks ago, something monumental happened. Tesla confirmed its new stock split. Stock splits always generate turbulence in the markets when they are announced because it means the stock is about to get cheaper. According to a study conducted by bofA securities researchers, since 1980, any stock in the S&P 500 which announced a stock split have beaten the market by 16% in the next 12 months. So investors are usually optimistic whenever a stock split comes around, especially when a large tech company is the one carrying out the stock split. On its August 4th annual meeting, Tesla shareholders approved Tesla for a 3-to-1 stock split. The stock split won't change Tesla's company valuation in the slightest. The only thing that is changing is the number of shares in the market. After the stock split, there will be 3 times more shares in the market. After the split, the number of Tesla shares will go from 2 billion shares to 6 billion shares. Tesla share prices will also be 3 times cheaper. The goal of stock splits are to make the stock more accessible to retail investors. Retail investors who couldn't buy Tesla shares before because they didn't have access to fractional shares can now buy Tesla shares at a more affordable price. While the valuation of the underlying shares won't change after the stock split, the cheaper stock price may attract more investors to buy the stock, which in turn drives up the price. Only certain types of companies split their stock. These companies are the ones that are optimistic about their future growth. There's no point in splitting a company's stock if the top brass knows that the company's valuation will drop in the future. No company would split the stock they expect to go down. So Tesla's stock split show Elon Musk's optimism for the company's future. Tesla isn't the only company doing stock splits this year. Shopify, Amazon, Google, and many other giant companies with healthy balance sheets have done stock splits this year. Many investors are curious about what Tesla stock will do before and after the stock split. This isn't the first time that Tesla has had a stock split. Its last stock split happened in 2020. So what happened to Tesla stock in the days leading up to the stock split, and what happened after that? So the last time Tesla split its stock was 2 years ago in the year 2020. Tesla did a 5-for-1 split so it could make its stock cheaper for retail investors. So you would own 5 shares for every 1 Tesla share you had previously. Elon Musk actually announced Tesla's proposed 5-to-1 split in March 28 in 2020. Tesla shares were around $400 per share at the time. After that, as investors waited in excitement for Tesla's stock split, Tesla's stock price shot up tremendously in the days leading up to the Tesla stock split, which was completed in August 2020. On the same month when Tesla was about to do its 5-to-1 split, Tesla's share price reached over $2,000 per share. Tesla shares went from $400 to around $2,000 per share. This means it became 5 times what it was worth ever since its stock split announcement. Then after the 5-to-1 stock split, Tesla's share price became $400 per share. Tesla shares took a slight dip in the days and weeks after its stock split. At one point, Tesla shares took a steep drop to $330 per share. Then its stock price hovered around the $380 to the $400 per share range for the next 2 months until it finally took off again, shooting up to $800 a share, more than double its value by the start of 2021 the following year. By the end of 2021, Tesla shares only reached $1,000 per share, but quickly dropped as 2022 rolled in and recession fears took hold. Tesla shares would continue their upward drop before slowly edging back up to its previous $1,000 per share highs in April 4th of 2022 this year. Then Elon Musk made the fateful announcement that he was going to buy Twitter stock, so Tesla shares hit the ceiling and tanked again. This was because Tesla investors were worried that Elon Musk would have to sell his Tesla shares to finance the Twitter buyout. Tesla shares could not handle the stress and flopped back down to a $660 low where it hovered around the $700 to $800 range. It was only in June when Tesla stock suddenly spiked up in price upon hearing rumors that Tesla was planning to do a 3-to-1 stock split. Retail investors who had been bearish about Tesla stock because of the Elon Musk and Twitter buyout drama tossed away their negative sentiment and piled into Tesla stock, buoyed by the possible rise of Tesla stock after the 3-to-1 stock split. bringing Tesla's stock price to the $900 per share that we see today. So stock splits have been a massive precursor in the past of Tesla's stock rallies. However, currently, the effects Tesla's stock split has on the underlying stock has been mild. There are no signs that it will rise above what it is now without any additional positive developments from the company. Now let's take a look at some of the other high-profile stock splits. Amazon had a 20-to-1 stock split this year. If investors bought shares prior to the stock split's recording date on May 27th, they would have seen their Amazon stock rise to $143 per share. That's a 24% rise in the stock price. However, that rise in the stock price had less to do with Amazon's stock split and more to do with their second quarter earnings. Investors were ecstatic when they heard Amazon's cloud business and ad business segment grew at a healthy rate. As a result, they piled into the stock. Amazon's stock price rose by 10% in a single day after that. If an investor decided they wanted to bet against Amazon and pin their hopes on another e-commerce company, then they would have bought Shopify stock before their stock split. For those who don't know, Shopify is an e-commerce solution company. Shopify provides anyone with tools to start their own online store and sell their products right away. Shopify takes care of inventory, payment, shipping, data, and server upgrades, while the business owner only has to focus on selling their products. Shopify did a 10-to-1 stock split on June 29th. Surprisingly, Shopify's stock price remained flat for 2 weeks in July. After the stock split, Shopify then reached a high of $40 per share by mid-August, more than a month after the stock split, indicating Shopify rose 21% after the stock split. However, despite this, it is important to note that Shopify is still down by 70% this year, so these gains are lower highs in a bear market. Shopify is over $127 below their all-time high of $167 per share. Moving on to more well-known companies like Google, they also did a 20-to-1 stock split, mirroring Amazon in July 15th. This time, Alphabet's stock dropped to $105 per share, Alphabet's lowest share price this year, barely 2 weeks after the stock split. Alphabet's stock price didn't remain in this low for too long. Immediately after Alphabet hit the $100 per share mark, it rebounded upwards, reaching $121 per share in mid-August. That's an 8% rise, barely 2 months after the stock split. Most of the stock splits I mentioned happened recently, so we will look at a stock that did its stock split a few years ago and see how it did in the long run. Apple is a company I'm sure a lot of people are already aware of. It sells iPhones, MacBooks, and is the second most valuable company on earth. Warren Buffett himself loves Apple stock. Half of Berkshire Hathaway's portfolio is made up of Apple stock alone. Apple did its 4-to-1 stock split in 28th of August in the year 2020. Since then, the stock has been on an upward trajectory, reaching $172 per share this August. That's a 38% rise in Apple's stock price, roughly 2 years after its stock split. All the stocks I mentioned rose in price after their stock splits. Now that doesn't mean stock splits guarantee the stocks rise a couple months later. Far from it. All the companies I mentioned are large tech companies which are popular among investors. They experience large growth yearly and make tons of money. Stock splits do not change the underlying value of the stock. The rise in a company's stock price relies less on the stock split and more on investors buying into the stock because they believe in the company. Tesla's stock split has a previous history of pushing up the stock price. However, history doesn't always repeat itself. There's no guarantee that Tesla shares will shoot up after its stock split. Investors buying into Tesla shares should be buying based on Tesla's future growth and not because of the stock split. However, it is a fact that Tesla's stock split will make it cheaper for investors to buy the stock. For people who want to participate in Tesla's stock split, they will have to hold Tesla shares past August 17th. Anyone who holds Tesla shares through August 17th will get 2 additional shares for each share they own as a dividend on August 24th. If you owned 1 Tesla share before, you would own 3 new Tesla shares in total after the end of August 24th. Tesla's revenues are constantly growing. Its second quarter revenues grew by 40% to $16.9 billion. Its adjusted earnings per share shot up to $2.27 a share, indicating a 50% rise. Tesla has consistently raised the number of cars it outputs over the years. So far, Tesla has delivered over 1 million Tesla cars in the past 12 months. Wall Street analysts bullish on Tesla stock expect its revenues to rise by 50% year over year to reach $85 billion, while its earnings per share should be $12.40 in a few years. All these positive developments for Tesla stock come at a time when inflation is lowering buying power and supply chain problems are throttling the ability of manufacturers to make products consumers want. Tesla's factory in Shanghai was shut down for a long time, so it's no surprise its earnings took a hit. Musk once described his Tesla factories as massive money money furnaces. They're investing a lot of cash for growth, so the supply chain issues means a lot of cash is being burnt with hardly any output. Achieving Tesla's initial target for 50% vehicle delivery growth this year is going to be tough. Tesla is doing all it can to meet its target of selling 20 million EVs by 2030 and 100 million Tesla cars in 10 years. Elon Musk is also planning to build another 10 more gigafactories to churn out Tesla cars. There are a lot of fans of Tesla stock. Ask someone which electric car they would buy if they had all the money in the world, and they would say they want a Tesla. Elon Musk's vision for the future are stunning, and many flock to his company because of SpaceX's many accomplishments in spaceflight. Plenty want to see Elon's trip to Mars succeed. Tesla is supposed to be Elon Musk's cash cow, a part of his master plan to fund his ambitions in space, so the billionaire will do whatever it takes to make sure Tesla succeeds. Tesla's stock price is poised to reach new highs in the future regardless of its stock split. The earlier you own the stock, the better. Before you go, this video is for entertainment purposes only. None of the information here is financial advice. Like and subscribe.